So ladies and gentlemen, I think we can get started. My name is Armagan Al-Haq. I'm the Manager of Program Development Partnerships and Finance with the Waterloo Institute for Sustainable Energy at University of Waterloo. And it's an honor to introduce our public speakers for today. The first one is Trezor Doherty, who is a doctoral candidate in sustainability management at the University of Waterloo, working in the fields of climate finance, energy policy, and risk governance. His research examines financial system stability along a low carbon transition. Trezor is a WISE Energy Policy Research Fellow awarded for his work on financial stability. And then our second guest speaker is Professor Olaf Weber at the School of Environment, Enterprise, and Development, SEED, University of Waterloo. And he is also a member of WISE. His research addresses sustainable finance, divestment, and sustainable finance regulations and guidelines. So I would like to welcome Trezor to please go ahead. It's all yours, Trezor.
All right. Thank you so much, Armagan. And thank you everyone for joining our webinar today. My name is Trezor Doherty, and along with Dr. Olaf Weber, we'll be talking to you today about decarbonizing finance, the risks, opportunities, and impact on the energy industry and climate change. So I'll start with a brief introduction on decarbonization. What is decarbonization? Where are we now? Before passing it over to Dr. Weber to discuss more of the recent developments in research on the topic. So I'll get right into it. We've been talking about emissions reductions for the better half of a few decades now. But what we've seen is through these incremental emissions reductions, our cumulative emissions have continued to rise. And so what we're proposing is the 2-degree framework, the 2-degree target to mitigate climate change, has really changed the narrative around this from one of incremental reductions to sort of an end goal that we have to hit to mitigate the worst effects of climate change. Now, in order to meet that 2-degree target, the vast majority of our current reserves can't be burned. In fact, only 1/5 of the total reserves that we have ready for extraction and use today can be used. And this is our carbon budget, the 1/5. So what happens to the rest? It's rendered unusable. It's written off the books as what we call stranded assets. And stranded assets are estimated to be anywhere from $2 trillion to $100 trillion. So we face this question now, a choice. Do we continue to burn fossil fuels and face climate crisis, or do we stop burning fossil fuels and face the cost of stranded assets? So I've been following this question for about 10 years now, and I've been looking at it from both the lens of social movements through Keep It in the Ground protests and the fossil fuel divestment movement, but also on the financial side through sort of this growing awareness and incorporation of climate risk into investment decisions. So I'll talk about each of those as we go along. Start off with the Keep It in the Ground protests. And we see that Keep It in the Ground, much the same way, has grown out of this question of this notion of if we continue to burn fossil fuels, we will face climate catastrophe. So we need to keep those resources in the ground. One of the first Keep It in the Ground movements was that of the Keystone Pipeline, which through those protests, the Obama administration at the time had canceled the Keystone Pipeline, citing fierce opposition and a failing economic case for this pipeline. We've since seen Kai activists stop Shell's Arctic drilling rigs on the coast of Seattle. We saw indigenous groups and climate scientists working together to stop what could have been the world's largest coal mine in Australia, the Carmichael coal mine. We saw Enbridge sell the Trans Mountain Pipeline to the Canadian government. And even in cases where indigenous resistance failed, such as the Standing Rock protests against the Dakota Access Pipeline, it rejuvenated a new wave of indigenous resistance across North America against pipelines. We've also seen actions taken by governments. 8 countries, including France, Germany, and Ireland, New Zealand, have taken assertive actions to ban exploration and extraction of certain fossil fuels in their lands. Now, fossil fuel divestment similarly grew out of the same idea that, if we do in fact stop fossil fuel extraction and production, what are the costs associated with those stranded assets? Fossil fuel divestment originally did start off as this moral argument, and it started with the argument that if it's wrong to wreck the planet, then it's wrong to profit from that wreckage. Right? It's quite a compelling statement that drove a lot of the early university as well as faith-based institution divestment pledges. But now there's this equally compelling financial case for fossil fuel divestment, as we've seen that fossil fuel companies and their stocks have sort of underperformed relative to the market. And Dr. Weaver will talk a little bit more about the research in this field. But just really briefly, some work that we did with Fossil Free UW sort of estimated that during that downturn of 2014, 2015, where fossil fuel companies weren't doing particularly well, the university, who currently has about 3% of their total endowment invested in these specific companies, could have lost well over $20 million just maintaining those investments, and that money could have been used to support students and faculty along. Now, on the financial movements, we see that sort of early advocates for divestment or for climate risk, such as Lord Nicholas Sturm, brought up the idea that there's this disconnect between how we're valuing fossil fuel companies right now and the climate policies that we have in place. However, at that time, it was largely dismissed by both the fossil fuel and financial industry. And that's largely because it was treated more like an uncertainty, something that climate, was something that we couldn't control rather than a risk as something we could control. And it was, for that reason, not incorporated into investment analyses. However, perhaps the most influential change came through about Mark Carney's time in 2015, where Mark Carney, former governor of the Bank of England, explained that inaction on climate change will threaten financial resilience. And since that point in time, we've seen increased reporting on stranded assets and climate risk, as well as investors demanding for better disclosure from fossil fuel companies. So we're seeing this sort of increase in awareness and response to the idea of climate risk. And we see that specifically, potentially most notably through the investor side of things, through divestment movements, the largest of which was the $1 trillion Norwegian sovereign wealth fund divesting from fossil fuels. We've also seen the same actions come out of lenders and insurers. For example, Europe's largest bank, BNP Paribas, as well as Swiss Re and AXA have all taken these positions to either stop lending or insuring select fossil fuel projects. And so we see these synergies coming up not only between these social movements and financial movements, but governments and industries as well, right? The Keep It in the Ground movements, for example, sort of delegitimized a lot of these projects, took away their social license to operate and dampened their commercial viability. Financial movements, even if a investor was divesting strictly for financial reasons, it sort of strengthened the legitimacy of keeping these resources in the ground and the social movements behind that. We saw governments take these assertive actions over that time, and industries as well, recognizing that these projects are losing their commercial viability, have walked away from a lot of them. So where are we now? And I have to be honest, we are moving so fast, it's hard to keep up sometimes. We see, for example, in this year alone, the world's largest asset manager, BlackRock, took a stance against investments with high sustainability risks, citing a fundamental reshaping of finance. We saw JP Morgan Chase take a stance against investing in Arctic drilling. And by now, it's no longer about who's taking this stance against, but it's who is continuing to invest in. I believe it's only the Bank of America who continues to invest in Arctic drilling amongst the American banks. Closer home, we saw thousands stand in solidarity with the Wet'suwet'en people. We saw Teck cancel their frontier mine, citing that this project surfaced a broader debate about climate change and Canada's role in addressing it. It'd be a huge coal mine here. We saw in Canada move down south and take thousands of jobs with it. And in this month alone, we saw 3 pipelines either canceled or shut down due to sort of fading economic case. And I couldn't even get the pictures in on this, but we saw Total Energy from France write off $10 billion of oil sands assets as stranded assets just a couple weeks ago. And last week we saw BP take a stance to reduce their carbon production by 40% by 2030, a lot of which will come from Canada and the oil sands. Locally in Canada, our banks continue to invest in fossil fuels. We're amongst the largest investors, and Dr. Weber will talk a little bit more about that. And our pension funds also maintain that we would rather engage with the industry, having lost close to $5.8 billion maintaining that stance. At home, credit goes where credit is due. The university has integrated environmental, social, and governance indicators into their investment decisions as a precursor to becoming a PRI, Principles for Responsible Investing signatory, and have recently joined the Pan-Canadian Charter of Universities, working towards decarbonizing their portfolios. So just sort of wrapping it all up, we face this question on whether we continue to burn fossil fuels and face climate crisis, or keep them in the ground and face stranded assets. And this sort of notion drove a lot of the early social and financial movements, but what we see now is that the idea of decarbonizing finance has really come center stage. And that'll be it for me. Thank you so much. I'll pass it over to Dr. Weber.
Thank you, Trusa, for the first part of the of this lecture, and I would like to continue to talk a bit about the current research we and other colleagues did, and so to give you some kind of numbers about what's going on currently, and what we do or what is done in research in the field. So sorry, my presentation does not move. Okay, so what we see currently, as it was mentioned before, that we still see big investments in the fossil fuel industry. So there's a report, the newest report from Rainforest Action Network, that is from 2019, and it shows that between 2016 and 2018, the investments in fossil fuel, and this is in Canada mainly in the oil sands, is not dramatically going down. It's even going up for some banks. And if you go 2 years back, it went up as well. So what we see especially in Canada, is that there still is an increase. And I think the latest numbers about kind of COVID-related stimulus investments globally also say that, you know, the combination with green investments is very low still, and that there's a lot of stimulus finance for the fossil fuel industry. So instead of seeing a decline, a rapid decline, a significant decline in investments in this field, we'd rather see continuing investment or even an increase. That's important to keep in mind. And so, but we have, as we know, we have the Sustainable Development Goals. And if Canada wants to achieve the climate goals, for example, climate action, SDG 13, wants to deliver affordable and clean energy, we have to do something. And so there is a strong role for the financial industry, for banks and other financiers in this field, because at the end, they are the one that provide the capital for different industries, such as the energy industry, infrastructure, and other sectors. So there's a strong role, and this role was acknowledged by an expert panel on sustainable finance that published a report in 2018. So just to summarize some of their main recommendations. So also they, similar to Carney, state that climate effects have significant effects on the economy, that Canada must invest in a low carbon economy transition. So we have to fund this transition. We cannot just wait until it happens. And finally, that the financial service industry has a key role to play in that. On the one hand, they are affected by different risks of climate change, so they have to develop any kind of tools to address these risks. On the other hand, they have the opportunity to channel money into the industries that they prefer and that are that will help to mitigate climate change. The question then often comes, isn't it too complicated? How do I know where I should invest? Is it complicated to figure out who are major emitters? What can I do? Do I need indicators or a lot of indicators to analyze who I should invest or where I should engage with? So there is a very interesting article, I think it was in Nature or even in Climatic Change, that analyzed the global GHG emissions. And what you can see there, and you see a list as well, that 19 carbon majors emit about 63% of CO2 equivalent emissions. So it's relatively easy to figure out who are the biggest emitters in the world. So, and then as an investor, you can, if you have the chance, you can develop a strategy to address that problem. That doesn't have to be divestment, of course. It can be engagement or other kinds of activities. But what is for sure is that these global major carbon emitters, they need capital to maintain or expand their business. So if they don't get the money from the financial industry or from other investors, they cannot maintain or expand the business. And one example is, as you see in number 3, even Saudi Aramco, that was the government-owned company in Saudi Arabia, went public because they need capital. And so investors can channel their investment either away from fossil fuels into green energy, or whatever that can do. But I think it's relatively easy to address this problem if you are an institutional investor. You can find out who are the major emitters and develop a strategy to deal with them, because you also have to keep in mind that investing in them might also be a risk for the financial institution if they are affected by major climate change policies or changes in climate change policies or changes in markets. So what are different financial mechanisms that can be used to invest in green industries or to avoid investing in fossil fuel industries? So what we see here, we have credit, the usual commercial lending process. We have green bonds, socially responsible investing, and divestment that Trusa already talked about a bit. So I want to start with credit risk and green loans. So what we found in our research is that banks that have a higher green credit ratio, meaning they have more green loans compared to other loans, to non-green loans, at the end have a lower non-performing loans ratio. So you can avoid risks by increasing the amount of green lending. And this is a study that we have done in China, but we found similar results in studies in Bangladesh and also in Europe, Germany, where we did some studies. The second finding for credit risks is that we can use so-called environmental, social, and governance criteria to increase the prediction, the quality of the prediction of the credit risk. So what we found in addition, if we use in sustainability criteria, environmental, social, and other criteria, and in addition to the usual conventional criteria we use to predict credit risks, then we can improve the credit risk prediction. And again, it will reduce risk and it will help to lend to the right borrowers instead to those that have higher risks. A second kind of financial product that is increasing rapidly over the last, let's say, 10 years are green bonds. Green bonds are bonds that are issued either by corporations, by companies that need money to invest in environmentally related projects. they can be issued by municipalities, by countries, by provinces. So we know in Canada, we know examples from Ottawa that has issued some green municipal bonds. Province of Ontario has issued green bonds already. And then there are Export Development Canada, for example, has issued green bonds, and also some of the big five Canadian banks, TD and RBC, have all issued these bonds. And what we see, there's an increase. I only have 2016-17 here, but it's increasing. So the amount of issuances is increasing over the last 10 years significantly. It's becoming higher and higher every year. And it's a very interesting product, especially for institutional investors, because the interest rates are more or less the same than those for conventional bonds. And in addition to that, you might avoid risk because it's a green bond, and also you might add to reputation because you invest more in green green projects instead in non-green projects. Another way to address the problem is socially responsible investment, and this is sometimes also called just responsible investment. And so that means that investors integrate environmental, social, and governance criteria into their investment decisions. They use these environmental, social, and governance criteria in addition to financial criteria, of course. This is conducted by mutual funds, institutional investors, sometimes by individual retail investors as well. But these are tools that are quite common in the meantime. So if you go back maybe 5 years, ESG was kind of a niche product. Today, more or less all institutional investors use some types of environmental and social and governance criteria to analyze their investments. And so it has become pretty common and pretty center for conventional finance as well. Usually we find about the same financial return or even higher. So this graph that we did an analysis during the last financial crisis, showing that SRI investments can have a higher financial return than conventional investments. In Canada, we have about 2 trillion invested using social or responsible investment criteria. Again, this is increasing. I think this is from last year or 2 years ago, so it's probably even higher. And of course, it depends on what you count as responsible investment. If engagement is already a responsible investment, but there are different ways to address this. But the result is that the responsible investment became kind of center instead of a niche product in the financial world. And we see this as well, as Trusa mentioned before. The University of Waterloo subscribed to the principles of responsible investments. They released a statement some time ago that that the university integrates environmental, social, and governance criteria into the investment decision. So it's becoming pretty common to do so. Finally, some data on divestment. Canadian analysis that we have conducted. So we use the TSX 260, the Canadian stock index, and what you see here, we had different ways to divest. So only from coal energy equipment, and others. So there were different strategies of divestment. I don't want to go too much into detail with that now, but what you can see is here in this graph, the red line is TSX 260 without any divestments, and all the other lines have some kind of investments. And what you clearly see here is that there's an overperformance of the risk-adjusted returns of all divestment strategies. So we can see that divesting in this case increase the financial returns, and instead of decreasing the financial returns, what is often mentioned. And it's important to say that this is the risk-adjusted return. So that means we take the volatility and portfolio theory into account as well, and not just focusing on pure financial returns without taking the risk into consideration. And this is for Canada, and there are other studies in the US worldwide as well that suggest suggest similar results. So there's an overperformance of divestment strategy. And a very interesting study from Europe even showed that the fossil fuel industry does not really contribute to diversity in a portfolio because it's so correlated to all other industries that it has created their own, it doesn't increase the diversity in the portfolio. And so I want to finish with some a study that we did on divestment announcements. So the one thing is, we have divestment strategies that change the financial returns. But the question is now, what happens if some big institution announces that they plan to divest from the fossil fuel industry, as Trusa mentioned before? And so we analyzed these announcements from big institutional investors, such as the Norwegian pension funds and other big pension funds, and then tried to find out what happens to the share price of the top 200 fossil fuel companies. And what you see here is that the fossil fuel industry is affected by these announcements. So we see if there's an announcement to divest, there's an impact on the share price of the fossil fuel industry. For that, we could show here that there's a significant negative abnormal return on the event day compared to global market indexes. So there's a negative impact on the fossil fuel industry. Finally, what are the consequences of divestment? So as I mentioned this, it looks like there's a better financial performance. And I don't think that in the future, because we see the oil prices going down, that this won't change fast. I think there are only some very strong, maybe political issues, wars in certain regions, violent conflicts that might increase in the oil price significantly. So I think also in the future we will see better financial performance of divested portfolios. There's an impact on fossil fuel related firms. We have seen that in the event study, and there are other studies by colleagues as well that analyzed what happens if big investors divest, and they even found that the market is already pricing this in currently. So it's not, it's even the market kind of perceives these risks in the fossil fuel industry. What it also does, it decarbonizes the portfolio, so it might reduce the risk exposure of these portfolios. And finally, it might lead to better reputation, because currently investors, there are many NGOs and other groups, and also private investors that think that institutional investors should do more with regard to investing in the green economy, and so it might increase the reputation of investors. So maybe I would just finish with something that is that everybody is discussing currently, of course. So what is the connection between green finance and COVID? So what are new findings there? And what is very interesting is that in Canada, the government has announced that post-COVID stimulus finance will use indicators of the Task Force for Climate-Related Financial Disclosures as a part of their financing process. So if a company applies for stimulus finance, they have to present data about their strategy with regard to climate change, how they address climate change, and how they want to reduce their emissions. So that's something, these are standardized indicators. That's something that will be used by the Canadian government. Some studies already found that this particularly green post-COVID stimulus is creating jobs. We know that green energy creates more jobs than fossil fuel industry, and this will even increase because we see this automatization, self-driving trucks and everything in the fossil fuel industry. But still, renewable energy is more dependent on jobs, and so it's creating jobs. And so it might be a green post-COVID stimulus might be a win-win for the environment and the economy at the end. And just the European Union decided to a very strong post-COVID stimulus package that is connected with addressing climate change. I want to finish with that as my last slide, and I will stop here. And I think we are open for questions and comments.
Okay, perfect. Thank you so much, Olaf. We are open for Q&As, and I would request Professor Ranjani Jha to please go ahead if you have a few questions, as you will be leaving shortly. Professor Jha, please go ahead.
Thank you, Armugan. That was a really interesting presentation. Thank you for that. So I just want to understand, when you look at fossil fuels, you're considering coal, oil, and gas, correct? Okay. I think one thing is, I can understand the analysis, etc. But the fact of the matter is, just divesting, say, energy stocks does not matter. As you have shown, the banks finance the energy industry significantly. Our Canadian industrial sector makes a lot of equipment for the energy sector. So many parts of the economy are essentially entwined in this. So it just, therefore the suggestion to divest and just stop the sector has a lot more in terms of consequences. The other thing is that many things in our lives are directly and indirectly impacted by this sector. Obviously, we think of transportation, but many of the things we use in our lives, there is an underlying component which is related to, say, oil. So all the chemicals, everything is interlinked. So therefore, again, it's not so clear-cut. And the third thing is, we don't have cost-efficient alternatives. A lot of it, for example, if you look at, say, Ontario, they've been subsidizing renewables. So my question is, how do you make this work? You can't just turn off the lights, and you need an effective alternative. So I just want to know, in terms of the research, what is happening. Because one thing is to assist the energy sector in transitioning, like I know BP, etc., they are considering that. So any thoughts on that? Thank you.
Yeah, sure. And obviously, yeah, there's a strong connection to other economic sectors in Canada. However, the question is, we have seen that in other countries. So I grew up in Germany. So Germany was coal and steel, as a big factor. And just staying in this industry that is obviously declining doesn't really help. So we can still invest in it, and it will decline sooner or later anyway, because there is a tendency of the use of less fossil fuels. And particularly for Canada, if there is a tendency of using less fossil fuels, then who will be out first? The most expensive one. And Canadian oil sand is definitely the most expensive one, and also one of the dirtiest fuels. We have to, have to say that. But so I think we can say, yeah, there is a massive consequence in if we think we have to move out of the fossil fuels, but it will happen anyway. And so the question is, instead of just keeping in and waiting, maybe we have to develop strategies. And I don't say, that we have to stop, financing everything. And especially what you mentioned in the other, I think your other comments, figuring out, how can we maybe use this money that we support the industry in a transition. What I could imagine, what we see now is, of course, there's a call from the fossil fuel industries post-COVID stimulus as well, but why not saying, yeah, of course you can get stimulus finance if you use that to transition to cleaner energies. And this, I think, would be a legitimate approach to do so. So I don't say that, we divestment is the final goal. And often now we also say it's investment on the other hand, but it's a divestment on the one hand, but investment into other industries on the other hand. So that might be the first. Then, yeah, of course, there will be still some oil will be used, sure, but there won't be a total divestment from the industry anyway. And there are many, and the amount that we still use or can use to not to increase climate change is relatively small. So there are these calculations that say, we have a budget at about 20% of what we currently have. So we can burn 20% of all the resources, and there will be enough money probably to develop these 20% still, even if we channel the money into different industries. The third one, cost-efficient alternatives, of course, they depend on how we support other industries as well. So if we go to Europe, other countries, photovoltaics and wind is definitely is often cheaper than fossil fuel alternatives. Of course, if we continue to subsidize fossil fuels like we do now, then we never get there. So, you cannot ask for, someone to say, you have to have your house using renewable energies if the gas bill is $50 a month. There's no way to make the case, but, but we have a relatively cheap price for energy because there's also government subsidies for that. And the question is, what can we do to change this? And other countries or other bodies also call for stopping these subsidies. And but you're right, we have to figure out and how we can create these cost-efficient alternatives. And I would say if you also have more investments in this field, then it will develop much faster than it does now. We see this electric cars. If there's big investment in batteries, we will have much cheaper cars, electric vehicles in the future. And why not? It's often a mass effect, and we see. I think the interesting example is Texas. I think the cheapest way to produce energy in Texas, that's the oil state, is photovoltaics in the meantime, because it's just there. So there's some, I don't want to, we didn't want to say that, we think divestment is the thing to do, but it's definitely an alternative, and there are other issues, other ways like social responsible investing, engagement as well, that will help. It was a bit long, but maybe.
No, thank you. I think that explains it. I think to your point, the market is already valuing the energy assets at a very low level. You're looking at energy prices, and there's also a lot of research and development of alternative technologies. Though we keep talking about electric cars, but you have to look at the source of the energy for that. There are environmental concerns about batteries. So everything, you are making a trade-off. I think so the fact is, there's a lot of research also going on, at companies like Suncor, etc., on reducing carbon emissions. I think some of that is not being reflected because those companies want to survive. And they are going to do what is needed so that they can also contribute to less environmental damage. So I think some of that should also perhaps come into the discussion. But nevertheless, you have to start somewhere. So I'm really very happy that I could attend the talk. One minor comment is the endowment is close to 2 billion. That, of course, includes the pension and benefits, which is around 1.7. So the endowment the university has for student and faculty fellowships, it's much smaller. Most of the money is in the pension and benefits, which is governed by the provincial regulations. So therefore, the provincial regulations don't permit you to divest energy stocks, etc. Until we get something like that, it cannot be done. So you have to work at it. Okay. Thank you very much.
Thank you. Thanks.
Okay.
In fact, you already divest from it because the share price is going down, and so yeah. I assume that that there's a certain point of divestment as well. But you're true, and that's what I meant with the responsible investment approach. Just does that. They will pick probably the most environmental friendly fossil fuel industries, for example. So that's another approach to do. That you say, or you pick, okay, who are the best in this field, and yeah, that's another way. Maybe there are other questions.
Thank you, Professor Jha. Thank you so much. So other participants, if you have more questions, please jump in. I guess not at the moment, but I would encourage our participants, if you have any questions, to please contact Professor Olaf Weber and Truzar Dodi. So I guess we can wrap up and we can finish.
There's one more question here from.
There is?
Yeah.
Yes.
Yeah, from Olga. I think I jumped a little bit late. Sorry. Thank you, Dr. Weber, and thank you, Truzar, and thank you for organizing this lecture. My question is, how fast we need to be to divest this 80% of emission? We said we have 20% of the old carbon we can produce in the future. So how fast we need to be to divest this 80%?
That's not easy to explain and to calculate. So the current status is now, I think, in research that we know what the financial consequences for divestment is for investors. We just start to figuring out what are the consequences for the fossil fuel industry. So how much will they reduce their exploration? So, and there will be political measures as well. Might be that there will be some regulations that will change that the amount of fossil fuels that can be burned. So I think probably divestment is not the only way to come to this 20%, but it's rather the other way. If we think there is only 20% that can be burned, it doesn't make sense to invest a lot anymore, because we have to figure out where these 20% are coming from. And these will be the cheapest sources and the cleanest sources. And so it's probably rather the other way. So divestment might reduce the ability of the fossil fuel industry to explore more. And we will work on that question in the future, how that works. But it might be rather the other way. But maybe Truzar wants to add something as well. I don't know.
Yeah, so that study, it's two studies, one by Meinshausen and one by Allen in 2009. So when they calculated the 565 gigatons we have currently, of which, or 1,200 gigatons, of which 500 we can burn, the 1/5, there's a chance that we may have burned through quite a bit of that in the last 10 years, right? So I agree. I think that number specifically is sort of a threshold that says, this is the end goal, and we really shouldn't be trying to push much further through there, and that suggests that in order to not push much further, the vast majority of them will have to stay in the ground, will face stranded assets, and will devalue the value of the fossil fuel companies, under the assumption that we're going to achieve a 2-degree target. Now, of course, there are going to be other solutions like carbon capture and sequestration, which is sort of in the works maybe. But as of right now, we sort of know that this is our upper cap, and I assume we're coming very, very close to that. I believe Meinshausen and Allen are planning another paper. A 10-year update on the global carbon budget.
So can we use this 20%, for example, for 50, 60 years later, and other stranded assets also can be used for 100 and 200 years after, right? Because eventually the environment can absorb some of carbon, I believe.
That might be, it might be, but you know, we have a currently, if there's no rapid change in technology or whatever, we have a certain budget, and that's it. And I think predictions are that even if we, you know, if we rapidly reduce the emissions now, they will stay for the next, I don't know, what is it, 100 years anyway. So there might be, you know, that in 200 years we can use that again, but probably then we don't need anymore because we have alternatives.
Yeah, probably. Thank you so much.
Okay, perfect. Thank you so very much, all of you. Do we have more questions? I guess not. It's perfect. So I would like to thank Professor Olaf Weber and Trezar for their wonderful presentation. Thank you so much. And when it comes to participants, if they have any questions, they can easily get in touch with both Professor Weber and with Trezar Dodi. Okay, perfect. Thank you so much for joining us. Have a great day. Bye-bye.
Thank you for organizing. Thank you. Bye.